The 188 member countries of the IMF have enacted a major modernization of the fund's governance. The realignment will give more say to many of the past decade's fastest-growing countries: Brazil, China, India, and Russia. These 4 countries will now be among the top 10 shareholders of the IMF. The IMF membership enacted the reform in response to changes in the global economy, as emerging markets countries have experienced strong growth and now play a much larger role in financial markets and trade. To be effective, the IMF must represent the interests of all 188 of its member countries, from the smallest shareholder, Tuvalu, to its largest shareholder, the United States. Unlike the General Assembly of the United Nations, where each country has one vote, decision-making at the IMF was designed to reflect the position of each member country in the global economy. Each IMF member country is assigned a quota that determines its financial commitment to the IMF, as well as its voting power. Total quotas are now being doubled, strengthening the IMF's capacity to respond to crisis and meet the needs of its member countries. The reforms also shift more than 6% of quota shares to dynamic, emerging market, and developing countries. The reform contains measures to protect the voice of the poorest countries of the IMF. Without these measures, this group of countries would have seen voting shares decline. The reform includes a reorganization of the IMF's 24-member executive board. There will be 2 fewer seats for advanced European countries, seats that will go to emerging market and developing countries instead, and all executive directors will have to be elected, providing for better representation and policy debate. The reform enters into force now that countries representing 85% of total voting power have accepted the proposed amendment.